let's look at the S&P 500. So first off, read this disclaimer carefully. So we find S&P 500 here. It's North America. We do see that it is 28% here from the 52-week low, and we are 1% away from the highs. So a pretty strong move. We do see here long term that there's certainly been a change in how the S&P behaves recently. We did actually have a bit of a bear market here between 2001 and 22. So if we measure from this high to this low, 27% loss is definitively bear market territory. That doesn't mean like that from the low you then get automatically like a bull run similar to like the dot-com bubble or the housing bubble. We are still, quite some distance away from those lows. But yeah, we have seen a reset. We also saw a reset relatively recently as well. Between this period here, we did get 11% correction. But we have seen a very strong rally now. It's been... so let's actually count it. So this is 13 bars. So we have had 12 weeks of us basically going up. So statistically speaking, like you would assume that at this point we might see a bit of a change. If you look at this rally here as an example, we didn't have that much bullishness before we had a correction. Like even during this rally here, we did see more correction than what we saw now. Let's actually look at this one. So 6 bars. So here we have 12 bars, then a mini correction, 15 bars, and then more of a pullback down to the 10-week moving average. A visit of the 10-week moving average would be 2-ish% loss, so not big. Here are the dailies. Seeing some pullback today, but basically just potentially visiting the 10-day moving average in this case, because we are now looking at daily data points and not weeklies. But yeah, let's look a bit at some other indicators as well. MACD is fairly high on the weeklies. RSI, you can see that we are in the same territory where we did see rejection back here. We did, however, if you look back here in 2021, we did have an extended period of us going a bit higher into the RSI territory. We were fairly overbought, but we did eventually get a correction. But like if you saw that we got like overbought here, and then you went short, you would have to withstand quite some pain until you got that nice profit. So yeah. Also, the PPOs, we are just elevated. Looking at the dailies here, something similar, some rejection here on the dailies. So let me go into my notes. So I do think that one could make a strong case that we are overbought. We're not like extreme overbought, but this is fairly high. So I will give the bears a -7 on this. We just sort of like do a bit of a correction. Here is the seasonality to the left of the last 5 years in green, 7 years in blue, and 10 years in red. There usually is some weakness into early February. Looking at the table view, 2.4% gain so far for January. February, we have recently seen weakness in the last few years in February. Looking at the sum here on the bottom, you see that February is it's not the weakest month, but it's a more mediocre month here for the bulls. So yeah, there is some bearish seasonality here on the horizon. Nothing like dramatic, but a bit. Yeah, so let's give the bears a -3 on this one. Let's look at the fundamentals. So I am comparing the S&P 500, the SPY ETF, against VT, the Vanguard Total World Stock ETF. So if we go here to performance, year to date, to 3.2% versus 1.23%. The last year, 24%, 16%. PE, 17.86 versus 15.4. And that's a bit of it's a significant difference. So if we calculate here the percentage difference between these PE ratios, we do get minus. So there's a 14% difference. So that is, significant. Yeah, yield, also a pretty big difference, but none of these are like, you don't get like amazing yield from any of these. Holdings, yeah, you do see some companies that repeat definitively between these two, though there's a huge difference between 1,000 holdings and 10,000. I mean, it sounds a bit odd. I do wonder whether this is off, because the numbers here are a bit too clean. So I do think that there's something wrong with the data. But definitively there's way more securities in the VT. But yeah, let's get into the notes. I do think that when it comes to the fundamentals, overall I would give the bears a -5. So yeah, I do think that there's some bearishness here. We're not like extreme, but we are definitely not cheap either. So we are in a position where we are like due a correction. So let's do it like this. SPY. I will now look at statistical correlations. So let's do it against the VT. And let's also do it against the VTI. So the VTI, it's a very total stock market. This is the total US stock market ETF. While the VT, that's the total world stock market. There's actually a lot of people who mistakenly buy these, thinking they have the other one. Compare it against GLD. Gold. Okay. So here are the weeklies. These are long-term correlations. So 83 with VT, the total stock market ETF globally. 97% with VTI, which is like a basket of a bunch of US stocks. 50% with gold, short term. Then we go to 70% correlation with gold, 98% with VT, and perfect with VTI. So what happens with VTI is going to have a pretty big effect here on the S&P 500. So the chart here looks very similar. We actually don't have the same breakout yet for VTI. Here are the weeklies. Rejection. So maybe there's going to be a bit of a pullback, then an attempted breakout. That's possible. We are a bit elevated. Yeah, so I mean, to have a breakout here, you need a bit of a catalyst. And we have already seen like a big move, so the psychology, right, is that you have a bunch of people now, a bunch of bulls with profits, and you have also bears, of course, that want to go short. But the problem here for the market is that you have the bulls who also do want to secure their gains. So you could also have some happy selling in this kind of situations. So yeah, let's look a bit here at the seasonality. Also a bit bearish here to the left, to the right. January, February, not particularly bullish months, at least recently. Okay. So now let's compare the S&P 500 with the VTI. VTI, like that. Yeah, so in terms of RSI, we are in the middle, so nothing special there. When it comes to in blue here, you see the relationship between the two. You could make the case that this is a bit like rounding bottom-ish. I mean, you could make that case. So let me draw that in. this is a bit of a rounding bottom. It's not clean, but there's something-ish about it. Yeah. Seasonality here. Yeah, let's also do the dailies. Yeah, just sort of very much in the neutral zone. Seasonality is a bit messy, so it's a bit sideways now, and then it actually is bearish into late April. The table view is not bullish for the S&P, so usually in January and February we see the S&P underperform the VTI. Okay, so to the left here we see a period of potential underperformance from S&P 500 versus the VTI, and the same thing on the table view. While in March we usually see the S&P 500 outperform the VTI. Okay, so this corroborates a more bearish thesis. Let's give it a -7. So S&P 500, the big ETF, the one that, and also the index that people watch. We are overbought, -5.5 in favor of the bears. I do think that there's reason to be a bit bearish here with the S&P 500. Not like a giga bear, but some kind of bearish position makes a lot of sense. And, you could, of course, put on like a bearish SPY trade and then have other bullish positions on. So overall, you are market neutral. So what I have now, at least in terms of like indexes, I am bearish the S&P 500, and I still have a bullish position on China. China is it's a market that's very far down from the highs, very far down indeed. So there's value. S&P 500, it's a bit of the opposite the case. We do see a bit of a breakout in development for the SPY, but I think that at least one should expect a bit of a break here. It's gone up a lot. And the key factor that I keep coming back to would be artificial intelligence. So while artificial intelligence will be very bullish for some companies in the S&P 500, there are definitively those companies where it could be extraordinarily bearish. So let's say that we see a new bank and it's an AI bank. So almost everything is just AI. Customer service is AI, fund management is AI. It's AI all over. That bank would be extremely disruptive and could take a lot of business from the other banks. And it would also be extremely scalable. That would, of course, be spectacularly bearish for a lot of companies in the banking sector, because they now would have a competitor with just a fraction of the employees and also with a much more modern tech stack. And that is just one example. And I do think that across a lot of industries, you have to be more careful going forward when it comes to what kind of investments you have. So, of course, it makes sense to be exposed to companies, but also think about, who makes the stuff further down the value chain, like, because that is when you can get into those companies which will benefit whatever happens. So whether it's a new technology, an old technology having a resurgence, whatever, it doesn't really matter. If they make, the raw material that is used for all of the other stuff, they will just be in business anyway. So it's like that is a benefit. Now you do have companies that have very interesting exposure to artificial intelligence. Microsoft, of course, Apple, also interesting stuff happening with Apple. Meta, also. Of course, none of these companies are like small caps to say the least. So a lot of the move from the low at least has happened. You also have Tesla. So there are these companies that will benefit, but just be aware of how extremely disruptive AI could be. So yeah, whatever you do, of course, you do want to let the trend be your friend and be market neutral.